Morning, and many thanks for joining us for this morning's briefing on the annual National Income and Expenditure results for 2020 and updated national accounts and international accounts results for Q1 2021. We set microphones to mute, keep them that way through the presentation on today's results, but we'll take some questions at the end of the presentations. And I ask people to use the Q&A function for questions, and you can be obviously loading in questions as the presentation goes on this morning. Today's results reflect the work of our annual revision process, and we've incorporated additional data detail that have become available into our provisional estimates. As in recent briefings, you'll see the impact of the COVID-19 related restrictions on the results for 2020 and Q1 2021, particularly on the indicators of domestic economic activity. So my colleagues will take you through the comparisons and the revisions in this morning's slides. Today's results also have some new information for users, including an estimate of net national income, or NNI, is the reduction there, at constant prices. The NNI indicator is part of the framework for national account statistics, and it's an important indicator of deglobalized economic activity. Previously, NNI was available in our results on a current price basis, but the new constant price NNI series gives another indicator of underlying domestic activity for users, and it complements indicators such as GNI star and modified domestic demand. And again, colleagues will take you through and show you how these series mirror each other in the results today. So slides from the briefing are available along with the statistical releases on the CSO website, and a recording of today's presentation will be loaded to CSO's YouTube channel. You can contact us at any stage later today or subsequently with queries on the statistics. Our contact details are always on the releases, and they're also available on the press release for this morning's briefing. So I'll pass to Chris, who will take us through the national accounts results, and then on to John, who will take us through the international accounts results. Many thanks.
Thanks, Jennifer. Good morning, everyone. I have a lot of data and information for you on the national accounts. This morning, as Jennifer mentioned, we've our detailed annual revisions to give you to the annual series up to 2020. The main headline from the national accounts data is an upward revision to the GDP numbers. So bringing in this new higher quality data for the annual series, our GDP number is now at 5.9% for 2020. So that's up from 3.4%, which was the sum of the quarters, the preliminary data we gave out for the quarters of 2020. Similarly, GNP is up 3.4%, up from the 0.6% from the sum of the quarters. So just to try and explain this a little bit, this is our standard set of revisions that we do mid-year, is to bring in the latest tax files. So this mostly affects 18 and 19 data, the base from the corporation tax and income tax records. And we also bring through the commodity flow estimates. So this is everything that's produced minus everything that's consumed in the economy, to check that we're covering consumption correctly. Along with our structural business survey data, mainly for 2019 there, bringing us a new base there for 2019 data into the income estimate and NIE. So there are standard revisions. We've also got other revisions on the data. So we've new IP towards the end of 19 and some more in the start of 2020. You'll notice that in a number of the series. But of course, these largely net out for GDP and for the growth rate. As Jennifer mentioned to you, we've also got a new variable, NNI, so net national income, which I'll show you that in a couple of the tables and how it's used. We've new consumption data. So if you look in the chapter called Consumption of Personal Income, we typically call it Table 13. You usually see a breakdown of consumption there. We now do it by product. It's the international standard called COACOP, International Classification of Products. So there's much greater detail now in that table, showing you the consumption data for the annual consumption data up to 2020. We also have the detailed NACE tables that usually come out a little bit later in the year. We brought them forward and they're in today's publication. So it gives you the NACE, of the sectors of the economy. There's 37 different sectors there, so it's really quite detailed. That's the data where we have some suppression on some of the sectors, but it gives you a much more detailed picture of what's going on in the economy, and you can pick out the multinational and domestic sectors and see how they're doing over time. So that's all available today. The impact of that on the data, across a number of years. As I mentioned, 2020 is up. The GDP number there on the top half of the slide is up to 5.9%. And for GNP, that's up in 19 and 20. So that they're the main revisions or the main impact of our revisions on the data. It's important at this point in the year, we don't normally talk about current price data, but it's important at this point in the year just to look at the current priced estimates of GDP, as it's used for a denominator for lots of different things. The current price estimate now is up to 372 billion, up from 366 billion when the sum of the quarters. And along with that today, we're able to produce GNI star, so our deglobalized measure. And the transition to that from GDP at 373 billion is to take off the foreign profits, mainly foreign profits, to get down to GNP. We have a slight change from GNP to GNI to take account of EU taxes and subsidies. And then the deglobalization adjustment then comes in, which is mainly taking off the depreciation related to IP and aircraft along corporate inversion income. That takes us down from GNI to GNI star, down at 208 billion. So that 208 is 56% of GDP. And that's important when we're using that again to divide things by. So two examples of that, if we take the April government debt numbers and we look at those, we can now see that they stand at 58.5% of GDP or 104.8% of GNI star for analysis purposes. And similarly for the deficit, that now stands at minus 4.9% of GDP and minus 8.8% of GNI star. So our government colleagues will have updated data on debt and deficit numbers in the coming days for you, but that's just to use the latest April government data with today's new denominator to look at those ratios. If we move back to the constant price data, we can see GDP and GNP both up at 5.9 and 3.4% in 2020. But then the deglobalized measures, GNI star, down 3.5%. And this new measure we have for you, NNI, net national income, is down 4.3% in the year 2020 over 2019. So what is net national income? Well, it's gross national income, GNI, minus all depreciation. So it's not a perfect measure of deglobalization, but one of the key features, as Jennifer mentioned, is it's internationally comparable. So it's tracking GNI star very well, and it's an internationally comparable measure. So we thought it was very useful to add that at constant prices now to the toolkit for people to look at. If we look at the headlines, so internationally, when people look at GDP, they're going to look at the Irish data for 2020 and see a growing economy at 5.9% in 2020. And I think lots of international commentators have looked at this and compared it, for example, to Italy, Spain, and Greece on the left-hand side of the chart. And of course, with the Irish data, we've got to look into it and see what's causing the growth. If we look at the income or output side of the accounts and look at the individual sectors, we can see the dominance of industry here. So this mainly M&E dominated industry sector is up 22% in 2020. And we've been tracking that through a lot of monthly data as we've shown you through the quarters. Like we've seen the huge rise in pharma through 2020 and then in the information and communications in 2020, and that is up 13.8%. We can contrast that with the domestic dominated data. So distribution, transport, hotels and restaurants is down 19.3%, and the important construction sector is down 10.2% for the year. We can look at those across time. If you go onto our website, you'll see the graphics for each of these. And these are interactive graphics. So as I keep mentioning, I guess to you, you can toggle these on and off to see, you can turn off the industries or sectors you don't want to look at, and you can see maybe a clearer picture of the ones I mentioned there. That there's dramatic growth, I guess, in industry in the year, and the continued strong growth in information and communications, and contrasting that with the two domestic sectors. Some people asked us at the end of last quarter about, what is it that's driving the M&E growth? So just to give you an example of this in information and communication, people say, well, what is this, the exports that John will talk about of computer services and the value added of the information and communication sector? When we talk to these companies, they give us lots of examples. And so the most common terms we hear across all the different meetings is this is software licensing, software development, software distribution, sale of web-enabled services, product research and development. That's common across a lot of the other sectors too, and product localization. So that's what the common terms we hear in the meetings with information and communication. That's just to give you an example of what's going on there. And we'll try and do something a little bit more on that for next quarter, maybe combined with some of the wages data to show you what's going on in the international or M&E sectors. If I flick over to the expenditure methods, so how does the expenditure method work? Well, we look at individual consumption, government expenditure, investment and net exports, and we build up GDP that way. We can see now that PCE or consumption is down 10.4%. Government spending, on the other hand, is up 10.9% with the continued spending related to the pandemic. Investment is down, but that's because of the IP volatility. But importantly, I think one of the driving factors on the expenditure side is exports are up 9.5%, and imports are down again related to IP. So we can peel away again the international elements to that. You can do this yourself on the website if you want to do it to see this picture. And it transitions us from GDP down to our modified measure. So the modified measure, modified domestic demand, is down 4.9% for the year 2020. And you can build that up from consumption, government spending, and then the gap between the stacked bar there and the blue line is a modified investment. So when we take out IP and aircraft, you're left with that element to bring you up to the blue line. So that's our modified measure on the expenditure side, modified domestic demand, and that's down at 4.9% in a year. Looking at the elements in expenditure, the international elements quite volatile. The net exports are determined essentially by IP, huge IP movements we see across the years. But I think one important picture to take from that is the growing blue bar there on exports, largely pharma-driven increases year on year in the exports data. And I guess John will talk a little bit more about that in the international accounts. We can look at that international element. We take the international element out, we're left with modified domestic demand. And we just applied this as a contribution towards the growth rate. So if we look at the growth rate in the year, and we look at the shares on that using modified domestic demand and exports of the international element, we can see the more domestic side of the accounts in blue there. So what's going on with the domestic part of the economy, modified domestic demand in blue, we can see the smaller increases each year with that, and the fall in modified domestic demand in 2020, reflecting what's going on with COVID in the year. If we look at the other elements then of the expenditure side of the accounts, we can see consumption. So this is down in Ireland, and we look at this against a selected group of European peers, and we see on their far left. So the strong fall in construction in 2020 puts us way out on the far left, one of the more extreme cases for the decline in consumption. What is it inside the consumption numbers that's fallen? So the total, the aggregates over there on the far right, and four of the driving factors are to the left of that. So it's foreign expenditure is one of the big elements that are down with the travel data. It's down. Spending on hotels and restaurants, recreation, and then transport services. This has been a consistent picture that we've had in all the quarters across 2020 and even into 2021 now. And that's still the main picture from the annual result. One of the new things we have today is an increased detail in the breakdown of consumption. So if you look in the chapter in the publication called Consumption of Personal Income, we call it table 13 at current and 14 at constant prices. And we have a much more detailed, what we call COACOP or product breakdown of consumption. So they're all the main items we just talked about that's giving you the big swings in the data there. But there's lots of other categories in there too if you're interested in what's going on with the consumption data. If we move to the investment data on the expenditure side, there's some interesting results here. So for 2020, the biggest increase, the biggest item that's increased is expenditure or investment in software. along with investment in machinery and equipment. So software is up 34% and machinery and equipment is up 14% in 2020 over 19. The large falls, you see, some of them are smaller categories, but the big one, I guess, to look at is transport equipment, down 38% at the bottom. It's mainly aircraft. Many of you you asked us this question, can we show investment in a particular way? So the total for investment is down 23%, but there's elements in there. The key elements that you're interested in is building and construction, down 5.5%, and the dwellings element of that is down 3.6%. With the remainder then of investment or capital formation down 25.8%, we can filter that again. So we look within it at machinery and equipment, and we see that the aircraft element is what's driving down machinery and equipment. And if we took aircraft out, machinery and equipment would be left a small positive 0.7%. So machinery and equipment, there's a number of things in there, but including that equipment item we saw increase strongly in 2020 along with software. Then intangibles, of course, IP is part of the story behind investment in Ireland, and that large negative is largely driven by that. If we take out the IP from the intangibles, we'll see that intangibles are actually up, mainly because of software, investment in software. That's up 20% when we move the IP out of the data. So they're the questions you normally ask us about investment. If we filter it a couple of different ways, what do we get? And on the annual accounts, then we put the income output expenditure data all together. We can see the GDP data up 5.9%, and then the transition to GNP is when we take off the net factor flows, or what many of you like to call the foreign profits. This is the net figure, of course, with income in and out. So that's going from 81 to 92.5 billion in 2020, which gives us our GNP growth rate of 3.4%. So that's the main new data that I wanted to talk about. Then I'll talk a little bit now about the quarterly data. Apologies, another slide to go. Just to sum up on the annual data, we've GDP up 5.9%, GNP up 3.4%, and the two new pieces of information today, GNI star is down 3.5%, and NNI is down minus 4.3%. They're all our headline numbers, and we can look at those two different ways, looking at the income or output method, and we see industries up 22%, along with information and communication up nearly 14%, and the domestic sectors are falling. And on the that side of the accounts, we can look at a split. We have the M&E and other sectors produced in the data. And that shows that the M&E dominated sectors are responsible for the growth, and the other sectors are down nearly 9%. So that sums up all those sectors to give you a kind of a big picture of foreign and domestic on that side of the accounts. On the expenditure side of the expenditure method, we see that the very domestic spending consumption number is down 10.4%. Government expenditure is up. And then we see a big rise or a big increase in net exports. And we put all that together, we can then modify it to give you modified domestic demand, taking out the international element. This is our modified measure on the expenditure side, and that's down minus 4.9%. Now, I'll move on to the quarterly. So when looking at the quarterly numbers, you have to remember we have a new base here. We've recast the annual, and the quarterly series is built off that annual base. So you have a whole new set of numbers to look at. So what are the main items? I guess we've restated the Q1 GDP growth rate up 8.6%. This was 7.8. That's up slightly. GNP is down slightly to 3.1%. And modified domestic demand in March, we gave you a figure of minus 2.9%, and that's down a little bit more now. So modified domestic demand is down to 3.5% for Q1. If you're looking at the quarterly data, we mentioned this last time that the current price has gone over 100 billion in the quarter. Now the constant price is over 100 billion as well. And that gives you an idea of the kind of scale of the growth in this data over time. One of the important elements when we're looking at this new set of data, looking at the time series, yes, we have the new growth rate in Q1 of 8.6%. But we've been working on the seasonal adjustment process to help refine it. Not so much changing the method, but looking for outliers, seasonal outliers in the data to help refine the process of seasonal adjustment. So when you're looking at the time series here, you'll see that it looks a lot better, I think, now for GDP. Q1 is positive, Q1 2020, and Q2 2020 is negative on GDP, with the rebound into Q3 and a fall in Q4 and a positive amount on GDP in Q1. So, of course, that includes the M&E activity as well as the more domestic facing side of the accounts. But I think it's a better time series now, seasonally adjusted for GDP. So just briefly look at the international comparison. Ireland is still an outlier here, I guess, with growth, strong growth in Q1 compared to our European peers. And same picture here appears when we look at the sectors. Growing industry, growing ICT, while falling domestic sectors, distribution, transport, and construction down quite strongly in Q1 because of the restrictions, I guess, on the economy in the quarter. Again, you can look at this on the website and simplify the graphics to the sectors you want, just kind of confirming that picture over time. The strong M&E growth has been there all the way through the pandemic, and the domestic facing sectors have been affected by restrictions, particularly in Q2 and again perhaps in Q1 2020. Of course, the timing of the lockdown restrictions around the quarters is important when you're looking at those numbers. If we look again on the output side, this is for the quarterly data. We can split it into M&E dominated and other. We can see that the M&E dominated sectors are responsible for almost all the growth in Q1. That's up 13.6%, while the domestic focused or other sectors that we showed here is down 1.2%. So that's kind of our adjusted measure on the output or income side of the accounts quarterly. The expenditure side of the accounts then, again, seeing all the different building blocks behind expenditure, and we can strip away the M&E elements to take us from the black GDP line to this blue modified domestic demand line. So we take away the exports and the modified investment, we can then build up to this blue line. And this number now for Q1 2021 is minus 3.5%. So growing GDP, and we put in through our modifications for globalization, we see the domestic measure is down 3.5%. Then looking at the elements inside the expenditure method, consumption is, as we had looked at, I guess, for Q1, down 5.9%, largely split between goods and services. And compared to our international peers, our European peers, just like with the annual data, we're on the far left still for Q1 in terms of restrictions and I guess the impact on consumption of individuals on goods and services in the Q1 data. On the investment side in Q1, we are restricted a little bit here because of the previous quarter's confidentiality, so we can't show you the growth rates other than to show you that building and construction is down. This is the investment in building and construction is down 17.1%. But we can look at it across time to show you that the picture is largely consistent through the quarters. We have no IP, large amounts of IP in the quarter. We can see a fairly consistent picture across the quarters. That's confirmed as well, I guess, if you look at the international data, the imports and exports, with the net exports being affected by IP. But I guess I'll leave this to John to talk about in the international accounts. So to give you a quick summary then on the, sorry, I keep doing that, looking at jumping too quickly. This is, again, just looking at the contribution to the growth rate. This is the modified domestic demand, or the domestic contribution to the growth rate in each of the quarters. And the blue part of the stacked bar there, again, tells you quite a lot about what's going on in Ireland in terms of domestic activity, with the fall in Q2, the rise in Q3, and then the falls again in Q4 and Q1 with restrictions. Now, and you bring together the two sides of the accounts to build up again to GDP. Again, we see that it's a large net factor flows, the foreign profits in Q3, and again now in Q1, that determines the GNP number in the quarter. So in summary, for the quarterly data, it's up 8.6% GDP and GNP is down 3.1%. On the output side, we see again the strong growing industry and ICT sector. And the modified measure on the output side shows you the M&E sectors and the domestic sectors. The M&E sectors, in summary, I guess, growing quite strongly at 13.6%, while the domestic or non-M&E dominated sectors are falling. On the expenditure side of the accounts, we see a fall in consumption again in Q1. Government expenditures down a little at minus 2.2%, but again, strong net exports in the quarter. So our modified measure on the expenditure side, modified domestic demand, gives us a value of minus 3.5%. So I'll hand over to John now for the international accounts.
Thank you, Chris. So now I'd like to take you through the international accounts. We have revised series for Q1 2018 to Q1 2021. And we also have some updated series, including our current account star and domicile PLCs and some new items. So to look at those in a little more detail, we can see that we have updated our domicile PLCs data for 2020, and we've also revised 2018 and 2019, and the same for current account star. This release, we've also included a US current account similar to our UK current account, and we'll look at that in a bit more detail later. And we've also introduced an institutional sector split for balance payments, and we'll go into that in a little bit more detail later. Our main data revisions across the quarters from Q1 18 up to Q1 2021 are mainly driven by the additional IP imports in Q4 2019 and Q1 2020. So first, our redomicile PLCs chapter. So this has been updated with 2020 data, and we've revised 2018 and 2019. We can see here the effect the redomicile PLCs have on our primary income flows, with their inflows reducing our net outflows. The redomicile PLC net income in 2020 was 4.5 billion, and this is down 356 million on 2019's figure of 4.9 billion. To look at their impact on direct investment abroad, we can see here that in 2020, redomicile PLCs had a stock of 439 billion in direct investment abroad, and this is 44% of our total of 987.5 billion. This figure for redomicile PLCs is down 86 billion on the 2019 figure of 525 billion. We've also updated our current account star for 2020 and revised 2018 and 2019. We can see here the large gaps between the current account balance and current account star in 2019 and 2020. And we can see the much smoother series for current account star. In 2018, a year with reasonably low IP, our current account balance is a surplus of 16 billion, while current account star is 13.3 billion. While in 2019, with large amounts of IP imports, our current account is a deficit of 70.8 billion, while current account star is 20.2 billion. And in 2020, again with large IP imports, our current account balance is a deficit of 9.9 billion, while CA star is 24 billion. To look a bit more closely at how CA star is put together and what's impacting that gap, we adjust for redomicile PLC income for the impact of IP and for the impact of aircraft. And these adjustments are consistent with GNI star and modified domestic demand. So we can see here how the different components sum to give us the overall difference between the current account balance and current account star. We can see the green block there in 19 and 20, that by far the largest impact in 19 and 20 is the IP imports. In 2019, IP imports of 116 billion are driving the gap between the current account balance and current account star of 91 billion. While in 2020, we still have large IP imports of 79.4 billion, but the increased depreciation up from 47.6 billion in 2019 to 61.3 billion in 2020 combined to give a gap of 33.9 billion between the current account balance and current account star. To look at our UK current account again, we can see that we have a trade balance in Q1 2021 of 4.5 billion, which is up 2.1 billion on the same quarter in 2020. This is driven by merchandise imports, which in Q1 2021 were 4.2 billion, which was down 1.5 billion on the same quarter in 2020. This gives us a positive merchandise trade balance with the UK for the first time since Q3 2017. The net income outflows are 1.5 billion in Q1 2021, which is down 1.7 billion. And these all combine to give us a current account surplus with the UK of 3.4 billion, which is up 3.8 billion from the deficit of 399 million in Q1 2020. The first of our new additions for this release is our US current account. So this follows on from our previous information note on the current account with the US, and we've added information for 2019 and 2020 and revised the data for 2018. We can see on this graph that in 2020, we have a current account deficit with the US of 23.6 billion, while in 2019, we had a current account surplus of 18.5 billion. You can see again in the green block that this is largely driven by increase in service imports from the US, which went from 58.2 billion in 2019 to 107.1 billion in 2020. And this is partially driven by growth in these imports, but also partially driven by changes in geography. You can see more detail on this in the release, and we also have quarterly data from Q1 2019 onwards. Our second new addition to the release is that Table 1.5 now shows the current capital and financial accounts split by institutional sector. So we can see the data split into general government, monetary authorities, monetary financial institutions, and other sectors, which are split into other financial intermediaries and non-financial companies. We hope that this will give better information on where activity is taking place, and it matches the split on our international investment position tables, allowing analysis across the two. To look a bit more closely at the revisions to our data since the preliminary release, we can see here a plot of our current account balance, with the blue line being the current account balance as it was in our preliminary release, and the yellow line being our current account balance as it is now. So we can see that the changes aren't very large except for in Q4 2019 and Q1 2020. In Q4 19, the deficit went from 28.6 billion to 58.8 billion. And in Q1 2020, the deficit went from 14.6 billion to 45.9 billion. To delve into that a bit more closely, looking initially at the revisions to net merchandise, we can see that there are some revisions to net merchandise. For example, in Q1 2020, the balance changed from 34.4 billion to 37.7 billion. But these are not the drivers of the changes we're seeing to the current account balance overall. Similarly, looking at our net income balance, we can see that there are some changes to our net income. For example, in 2020 Q2, the outflow increased from 20.9 billion to 22.8 billion, while in 2020 Q4, the outflow decreased from 21.5 billion to 18.7 billion. But again, these aren't the main drivers of the changes to the current account balance. Moving on to the services, we can clearly see that this is the main driver of the change to our current account. In 2019, the services balance, in 2019 Q4, the services balance went from minus 37.3 billion to minus 68.5 billion. And in 2020 Q1, the services balance went from minus 28.2 billion to minus 61.6 billion. So we can see that this is the main driver of the change to our current account balance, and this is mainly driven by the increased IP imports in those two quarters. So to look at our summary results for the year, we can see that our merchandise surplus has gone from 109.4 billion in 2018 up to 118.1 billion in 2019 and up to 145 billion in 2020. While our net income outflow has increased from 77.1 billion in 2018 up to 83.3 billion in 2019, up to 92.9 billion in 2020. While the more volatile services balance, again largely driven by the changes in IP, has gone from minus 16.3 billion in 2018 to 105.6 billion in 2019 to 61.9 billion in 2020, and all of those negative balances. These combine to give us our current account balance across the 3 years of a surplus of 16.6 billion in 2018, a deficit of 70.8 billion in 2019, and a deficit of 9.9 billion in 2020. Whereas when you look at our current account star, which removes the globalization effects, we can see a current account star of 13.3 billion in 2018, 20.2 billion in 2019, and 24 billion in 2020. Looking at the revised quarterly figures, we can see that our merchandise surplus in Q1 2021 is 43.7 billion, which is up 6 billion on the Q1 2020 figure of 37.7 billion. Our net income outflow has increased from 22 billion to 29.6 billion over the same period. And our services balance has gone from minus 61.6 billion in Q1 2020 to plus 5 billion in Q1 2021. And again, the difference here largely driven by the difference in IP between the two quarters. And these combine to give us our current account balance of minus 45.9 billion in Q1 2020 and 19 billion in Q1 2021. We can see here our infographic, which gives a good summary of the results. It gives our goods and services and income balances, which again all combine to give us our current account balance of 19 billion or 18.8% of GDP. And we can also see that our net international position stands at minus 638 billion at the end of Q1 2021, while our stock of foreign direct investment in Ireland stands at 1,153 billion at the end of Q1 2021. So I'd like to pass back to Jennifer now to summarise the results.
Thanks very much to Chris and John for taking us through the results for today. And I guess it's just to pull some of the key messages from all of the data that you've seen here today. The infographic helps a lot, and I'd like to, I suppose, point out some of the indicators that will help give you that whole of economy view and then maybe a more granular view of what's happening. And in 2020, we have seen that very, very strong GDP growth of 5.9%. We compare it to other countries, GNP growth of 3.4%. What you will have seen in the results, the strong export performance that's been driving that GDP result. When we look then at the whole of economy indicators that have those globalization impacts removed from them, down on the bottom corner there of our infographic and in the center there as well, you'll see GNI star actually contracted by 3.5% in 2020. And then NNI, the new deglobalized indicator that we've included in the results, in the NI results for 2020, contracted by 4.3% in 2020. NNI closely mirrors the GNI star series, and you'll have seen that in the graphs. So that gives you a sense of what's happening overall in the economy when you take out these globalization effects. And just drilling in a little bit more on the domestic activity, we've seen the decrease in modified domestic demand of 4.9% in 2020. So that's spending on investment by persons and by government as well. So that's an important indicator, I think, of what's happened in the year. And then the very important personal consumption indicator contracting by 10.4% in the year, reflecting over the different quarters the different levels of restrictions that have applied because of the COVID-19 pandemic, but significant impact overall in the year on personal consumption, a decrease of 10.4%, just to highlight that again. For quarter one, 2021, similar story, strong GDP growth, 8.6% in the quarter, but then take away the globalization impact and we see our modified domestic demand contracting by 3.5 or decreasing by 3.5% in quarter one, 2021. And our personal consumption, what we all spend on goods and services in quarter one, 2021, contracting by 5.9%. So many thanks for your attention this morning.